Study after study shows remote work leads to higher productivity, lower turnover, and fewer mistakes. For example, Stanford research found remote workers were 13% more productive. Yet major companies like Amazon, Dell, and Walmart are now pushing strict office mandates. Despite evidence that remote work boosts output, financial pressures and real estate interests are driving a growing return-to-office movement. Commercial real estate delinquencies reached 6.4% in early 2025, putting pressure on companies to fill office space, even when it means ignoring what works best for employees and profits. This gap between data and decisions is only getting wider. The productivity paradox. Despite mounting evidence that remote work drives better results, companies continue to double down on office mandates. This contradiction is often called the productivity paradox. Organizations see measurable gains from remote teams, yet respond by increasing in-person requirements and surveillance. Stanford's research found remote workers were 13% more productive and had 50% lower attrition rates. In software development, a 2025 study highlighted that remote developers committed 22% more code, directly challenging the belief that in-person presence is essential for technical output. Yet, 78% of tech firms now require hybrid attendance, with mandatory office days that ignore the data. This pattern isn't limited to tech. Bank of America's internal analysis showed remote loan processors handled 15% more applications with fewer errors, but the company still mandated office attendance for most of its back-office staff. Surveillance technology is now a fixture in the remote work landscape. Many firms have ramped up monitoring tools, even though there's no evidence these measures improve performance. According to industry reports, the use of employee tracking software has risen by over 40% since 2023, but studies show no correlation between monitoring and productivity. In fact, research from MIT found that heavy surveillance reduced employee engagement by 18%. Despite these findings, companies continue to invest in monitoring systems, sometimes tracking dozens of digital activities per worker. This trend suggests a growing gap between trust and output. Employees deliver more, but management responds with more oversight, not less. Microsoft's Workplace Analytics division noted that while output metrics improved for remote teams, managers struggled to assess individual contributions. This difficulty has fueled the rise of monitoring tools, with surveillance software companies reporting triple-digit revenue growth since 2023. The result is a work environment where employees are measured by their digital footprints instead of results. Economists describe this as productivity theater. Workers performing visible tasks to demonstrate activity rather than focusing on meaningful output. The paradox extends into financial services. Goldman Sachs found that remote analysts produced more financial models with fewer errors, yet the firm introduced strict office attendance policies, justifying them with cultural alignment. Engagement surveys, however, showed remote employees reported higher job satisfaction. In other sectors, the pattern holds. United Health's remote claims processors processed more claims with fewer payment errors, but the company still implemented weekly in-office days in the name of quality control, even as their own metrics showed no difference between remote and office work. Corporate leaders often cite collaboration as the reason for office mandates, but data from McKinsey's 2025 study found most knowledge workers spend less than 2 hours per week on activities that benefit from physical proximity. Creative professionals, like graphic designers, produce significantly more portfolio-worthy work remotely, according to Adobe's Productivity Index. Promotion data reveals another layer of the paradox. LinkedIn's analytics show remote employees receive better performance reviews on average, but are substantially less likely to be promoted. Office workers advance after 18 months, while high-performing remote employees wait nearly a year longer. This suggests that, for many organizations, visibility still outweighs actual performance. These contradictions come at a real economic cost. Deloitte estimates U.S. companies lose billions each year maintaining office infrastructure and control systems that do not translate into higher output. As organizations continue to prioritize presence over performance, the underlying reasons for these decisions become more apparent, especially when considering the financial pressures facing commercial real estate. Real estate domino effect. Commercial real estate is under severe strain as vacancy rates reach record highs and distress ripples through the market. In the first quarter of 2025, commercial mortgage-backed securities delinquencies hit 6.4%, triggering covenant violations across the industry. Office valuations have fallen by over 30% in top markets, reflecting the sharp decline in demand as more companies shift to hybrid or remote work. For property investors and real estate investment trusts, this drop is a direct hit to balance sheets, making it harder to justify the value of office portfolios to shareholders. Municipalities are responding with policies designed to prop up occupancy rates and protect local tax bases. Cities like Chicago have offered property tax deferrals to companies that keep office occupancy above 60%. In New York, payroll tax credits are tied to employee badge-ins, pushing firms to maintain a physical presence even when remote work would be more cost-effective. These incentives are at odds with the cost savings companies report from remote work. But for city budgets that rely on commercial property taxes, keeping buildings full takes priority. Banks are deeply exposed to this sector. Wells Fargo has 3.8% of its loan book secured by commercial office space, totaling $37 billion. JP Morgan and other major lenders face similar risks. Every 10% drop in office valuations forces banks to increase reserves, straining their capital and prompting them to pressure corporate tenants to keep space occupied. Regional banks are especially vulnerable, sometimes holding office loans that amount to several times their capital reserves. This exposure creates a powerful incentive for lenders to support return-to-office mandates, regardless of what productivity data may show. Long-term leases add another layer of complexity. The average office lease runs 7 to 10 years, often with expensive build-outs costing $250 to $500 per square foot. Many companies are still locked into contracts signed before the pandemic, paying for space they no longer need. Early termination comes with steep penalties, often more than 2 years' rent, so it's common for businesses to require office attendance simply to justify ongoing expenses. This mismatch between real estate commitments and actual workspace needs leaves companies looking for ways to optimize, such as subleasing excess space or implementing desk-sharing systems. Despite slumping demand, 125 million square feet of new office space is still under construction, keeping companies tied to outdated leases and further depressing prices. Developers are reluctant to cancel projects, as doing so could trigger loan defaults, so the supply glut grows even as utilization rates fall. On mandated office days, average occupancy reaches only about 49%, dropping to 12% on Fridays, according to occupancy tracking data. Tax policies reinforce these dynamics. In major cities, office buildings account for 25% to 40% of all property tax revenue. Local governments have offered incentives to large employers, such as direct payments or tax breaks, in exchange for keeping workers downtown. When Boston extended $25 million in incentives to a major bank, strict in-office requirements followed almost immediately. This pattern repeats in other cities, where economic dependencies on office workers shape policy decisions. Real estate investment trusts are feeling the pressure as well. Boston Properties, one of the largest office landlords, wrote down assets by $1.7 billion in 2024, and now seeks to renegotiate leases with tenant companies, sometimes trading rent reductions for stricter attendance policies. Appraisal practices lag behind the reality of hybrid work, with many buildings still valued based on outdated rental income projections, even as actual occupancy and revenue fall. Meanwhile, the effects extend beyond landlords and tenants. Downtown small businesses, from restaurants to dry cleaners, depend on office worker foot traffic. As offices sit empty, these businesses suffer, prompting local business groups to lobby for return-to-office policies. Insurance companies have started factoring occupancy into premiums, charging higher rates for buildings below 60% capacity due to increased claims risk, adding another incentive for landlords to push for higher attendance. The structure of commercial mortgage-backed securities makes it difficult to adjust quickly. Defaults in a single building can trigger technical defaults across entire portfolios, so lenders often tolerate underperforming assets rather than force sales. At the same time, the majority of current office leases won't expire until 2027 or later, setting up a prolonged standoff between companies, landlords, and lenders. These pressures shape corporate policies in ways that often disregard productivity data, as companies navigate a landscape where financial obligations to office space outweigh the clear benefits of remote work. Underneath these decisions, another trend is emerging, one that quietly reshapes the workforce as companies adapt to the realities of post-pandemic business. The layoff loophole. Return-to-office mandates have become a preferred tool for companies looking to quietly reduce headcount, without resorting to formal layoffs. Rather than announcing job cuts, firms implement strict office attendance policies, knowing that a significant share of employees will choose to leave on their own. A June 2024 study found that 20% of employees are unlikely to stay if forced back to the office, a figure that rises among certain groups like women and senior technical staff. Investment banks have used RTO policies to drive voluntary departures and avoid formal severances, sidestepping the negative press and costs associated with layoffs. When Amazon mandated attendance for its cloud division, Q4 attrition rates spiked noticeably among remote-capable teams. Internal communications made it clear that employees unwilling to comply with the new badge-in requirements were free to leave. This approach allows companies to reduce staff numbers, avoid severance payouts, and bypass layoff reporting requirements. The financial logic is straightforward. Voluntary resignations are cheaper and less visible than formal terminations. Companies tend to tighten RTO policies after periods of poor financial performance. A 2024 study of S&P 500 firms found that businesses were 42% more likely to require office returns following a dip in stock price. Investment banks illustrate this pattern. After a significant revenue drop, JP Morgan quickly implemented stricter office attendance rules, which led to a marked increase in attrition, especially in back-office roles. Similar strategies play out across the tech sector, where badge-in requirements and mandatory office days are often introduced after disappointing earnings. These policies do not impact all employees equally. Women resign at higher rates than men after RTO mandates, and senior technical staff are more likely to leave than junior employees. As a result, companies often lose experienced and high-performing workers while retaining those more willing to comply with office demands. This shift can create a skills gap and reduce overall productivity. The consequences are not limited to retention. Recruitment becomes more difficult for firms with rigid office requirements. According to a 2025 Robert Half survey, 37% of job seekers are only interested in fully remote roles, and companies with strict in-office policies take significantly longer to fill open positions. After JP Morgan's RTO announcement, the average hiring cycle lengthened by nearly 2 weeks, and the number of qualified applicants for technical roles dropped. Diversity also suffers. When positions shift from remote to office-based, applications from women fall by 15% and from underrepresented minorities by 33%. Remote roles attract a broader talent pool, and companies that maintain flexible work policies see more diverse teams. In contrast, strict RTO mandates often result in less representation and slower progress toward inclusion goals. Productivity data reveals another layer to the trade-off. Stanford's research shows that remote workers maintain higher output due to fewer interruptions and more focused work time. When high-performing remote employees leave, their replacements, typically office-bound, often produce less in the same roles. This dynamic can erode a company's innovation capacity and long-term performance, even as short-term costs decline. Financial incentives from landlords and municipalities reinforce these trends. Office landlords may offer rent reductions in exchange for higher attendance rates, and cities sometimes provide tax credits tied to badge-ins or occupancy thresholds. These arrangements further encourage firms to prioritize office presence, even when it conflicts with employee preferences and performance data. Generational differences add to the complexity. Younger employees, especially those in tech, are much more likely to resign after RTO mandates than older colleagues. This accelerates the loss of digital skills and creates a widening gap in emerging areas of expertise. For middle managers, RTO policies offer a way to reassert oversight and maintain visibility, even if it means reduced output for their teams. Many managers report struggling to demonstrate value in remote settings, so bringing staff back to the office becomes a means of regaining control. Despite the clear evidence that RTO mandates cost companies top talent and diversity, the desire for control and the pressure to fill office space continue to drive these policies. This sets the stage for deeper tensions between leadership and employees, as trust and productivity data are often ignored in favor of visible presence. Management's control crisis. Management's control crisis is now at the center of the remote work debate. As companies adapt to distributed teams and changing labor markets, many leaders struggle to reconcile the clear productivity data with their own perceptions of oversight and accountability. A 2025 Gartner survey found that 61% of executives remain skeptical about remote workers, even as performance metrics show these teams deliver equal or better results than their in-office counterparts. This skepticism often has little to do with measurable output and more to do with a perceived loss of direct control. Middle managers, in particular, face a growing crisis of relevance. With teams operating more independently, 42% of managers admit they struggle to demonstrate their value. The shift away from direct supervision has left many in these roles searching for ways to justify their positions. Internal studies at major firms show that managers spend significantly less time in meetings when teams are remote, which disrupts routines built around regular check-ins and status updates. This has led to the rise of mandatory in-person meetings with little substantive purpose, sessions designed more to maintain managerial visibility than to improve outcomes. This focus on visibility has fueled what researchers call productivity theater. Employees often come to the office primarily to be seen, then return home or log back in after hours to complete actual work. The pattern is clear in badge data and login records. Office presence is maintained for appearances, but the real work happens elsewhere. Employees report losing hours each week to commuting and non-essential meetings, while project delivery timelines and quality remain unchanged or even improve in remote settings. The labor market shift has only amplified these dynamics. As hiring slows and job openings decline, employers have less incentive to offer flexible arrangements. Office mandates become a tool to reassert traditional hierarchies, especially as the balance of power moves back toward management. Some companies tighten attendance rules precisely when job seekers outnumber open roles, using the broader economic climate to reinforce control. Cognitive biases further entrench this approach. Managers are more likely to remember isolated incidents of remote employees underperforming than months of positive productivity data. Behavioral economics research shows that negative anecdotes linger, shaping policy decisions even when they contradict the evidence. Surveys consistently find that a majority of executives believe office culture prevents slacking, despite their own internal metrics showing remote teams match or exceed in-office productivity. The demand for employee monitoring has surged since the pandemic. According to industry reports, 40% of companies increased surveillance of remote staff, adopting tools to track activity and presence. This trend persists even as research shows that such oversight actually reduces engagement and productivity by 18%. Instead of building trust, surveillance fosters a culture of visibility over value, where being seen is prioritized over delivering results. These cycles become self-reinforcing. Managers who distrust remote teams impose stricter controls, which in turn lowers engagement and actual output. Even when pilot programs show that autonomous teams outperform micromanaged ones, organizations often expand monitoring or badge tracking systems rather than shift their approach. The focus remains on presence and compliance, not on results. In sectors like finance and tech, these patterns are especially pronounced. Firms require in-office attendance for reasons of culture or quality oversight, even when their own data points to better performance from remote or hybrid teams. Status rituals and physical office spaces continue to be valued, often at the expense of innovation and measurable outcomes. Promotion and advancement are also shaped by these dynamics. Employees with high office visibility are more likely to be promoted, regardless of output. This incentivizes performative behaviors, attending unnecessary meetings, being seen in common areas, over actual contributions. Internal communications at some firms even advise staff to prioritize visibility with senior leaders as a career strategy. Generational divides add another layer. Younger employees show higher engagement and satisfaction with digital collaboration, while older executives continue to value traditional in-person rituals. The gap between what drives performance and what leadership rewards continues to widen. These tensions over control and visibility are reshaping how companies define culture and success. As organizations grapple with these challenges, the next frontier is emerging: how generational expectations and digital habits are transforming workplace culture itself. Culture Clash 2.0. Culture Clash 2.0 is taking shape as companies attempt to balance the expectations of a workforce divided by age, experience, and digital fluency. The differences are stark. Younger employees, especially Gen Z, show a clear preference for digital-first processes, while older leaders continue to value in-person rituals and office presence. This tension is most obvious during onboarding. Surveys show that 68% of Gen Z new hires prefer fully digital onboarding, reporting higher satisfaction with virtual introductions than with traditional in-person orientations. Yet most large companies still insist on week-long, in-office onboarding programs, even though remote hires often reach full productivity faster. Startups and digital-first firms have adapted, seeing higher retention and engagement among new employees who onboard remotely, while legacy organizations struggle to bridge this divide. The myth that strong culture only develops through face-to-face interaction persists, but recent data challenges this assumption. Studies from 2025 indicate that remote teams can form robust digital bonds, with hybrid and remote groups often reporting a greater sense of belonging than those working exclusively in offices. Digital collaboration tools, structured virtual meetups, and asynchronous communication channels help build connections across distances. Despite this, many companies continue to justify office mandates with references to spontaneous hallway conversations, even though these interactions account for a small fraction of actual work output. Generational gaps in workplace preferences extend far beyond onboarding and culture building. Executives over 55 are 3 times more likely to value office presence than employees under 35, according to recent surveys. This difference plays out in promotion and advancement, with office-based employees advancing more quickly than remote peers, regardless of performance. Teams with age-diverse leadership consistently report higher innovation, but many organizations still default to traditional models that favor visibility over results. Work patterns and productivity also reflect generational divides. Younger employees are more likely to report higher productivity outside the office, with 84% of Gen Z workers indicating they do their best work in hybrid or remote setups. Older employees, while still benefiting from flexible work, tend to show smaller productivity gains. These patterns have real consequences for talent retention. Companies clinging to rigid office policies see higher turnover among younger staff, while those offering flexible arrangements retain a broader, more diverse workforce. Mentorship and training reveal further differences. Gen Z employees prefer structured digital mentorship and microlearning apps, engaging with these formats far more than with informal, in-person coaching. However, most executive development and training budgets still favor traditional seminars and physical attendance, resulting in lower participation from remote-capable staff. This mismatch slows leadership development and creates bottlenecks in the talent pipeline. Regional differences shape these trends as well. North American companies maintain higher office attendance requirements, while firms in Europe and Asia-Pacific have embraced hybrid and remote models more fully. Flexible work policies in these regions correlate with higher retention and job satisfaction, especially among younger and more digitally native employees. Diversity and inclusion efforts are also affected by the push and pull between remote and office work. When roles shift from remote to in-office, applications from women and underrepresented minorities decline, reducing representation and slowing progress toward inclusion goals. Remote and hybrid options, by contrast, attract a wider talent pool and support more diverse teams. Physical workspace preferences further highlight generational contrasts. Gen Z employees value quiet spaces and focus pods, while older managers often prioritize open-plan layouts and collaborative areas. Companies that invest in infrastructure supporting deep work see higher retention among younger staff, yet many organizations continue to favor traditional designs. Even compensation and benefits reflect the culture clash. Younger employees are willing to accept lower pay in exchange for remote flexibility, while older workers prefer office-based perks and location bonuses. Wellness benefits also diverge, with Gen Z prioritizing mental health apps over on-site gyms, though most HR budgets still focus on in-person amenities. Scheduling and communication styles round out the divide. Gen Z favors asynchronous tools and flexible schedules, while older executives pack their days with meetings and synchronous calls. This results in younger leaders reporting more focused time and less meeting fatigue, while older managers spend hours each day in scheduled sessions. As these generational and cultural gaps widen, companies face increasing pressure to adapt policies, infrastructure, and management practices. The struggle to define and maintain workplace culture in this new environment is leading organizations to seek out new tools and strategies, often turning to digital monitoring and surveillance in an attempt to regain a sense of control. The surveillance surge. The rise of employee surveillance has become a defining feature of the modern office, especially as companies enforce return-to-office mandates. The employee monitoring software market is now worth over $9 billion, with a growing share of firms adopting digital oversight tools. Among companies requiring office attendance, 83% use keystroke tracking and similar software to monitor daily activity. Banks and large corporations have taken this further, logging hundreds of discrete actions. Everything from typing speed to application switching across employee devices. This level of monitoring is no longer limited to remote work. It now shapes the experience of being in the office as well. The intention behind this surveillance is to increase productivity and prevent slacking, but the data paints a different picture. Microsoft's 2025 Workplace Analytics found that departments under heavy surveillance report lower engagement scores. Teams subjected to constant monitoring completed fewer projects on time, despite putting in longer hours. Instead of focusing on meaningful work, employees spend more time demonstrating activity for the system, a phenomenon economists call performance pantomime. Employees log in early, stay late, and keep applications open, but the quality of output often declines. Badge tracking has become another tool in the surveillance arsenal. Some companies now require employees to swipe into buildings or specific floors every 2 hours, aiming to prove physical presence. This creates a culture of presenteeism, where employees prioritize being seen over being productive. Actual desk occupancy remains low, but the number of badge swipes and logged hours continues to rise. Workers have adapted by finding ways to trigger sensors or swipe in for colleagues, further eroding the connection between presence and performance. The creative sector offers clear examples of surveillance's unintended consequences. Graphic designers and other knowledge workers produce fewer original concepts when monitored closely, even if they spend more time at their desks. The most valuable work often happens outside the boundaries of what tracking tools can measure, during offline periods or spontaneous bursts of creativity. Surveillance systems, by design, struggle to capture this kind of output and instead reward visible busyness. The effects extend to other industries as well. In healthcare administration, claims processors under strict monitoring processed more claims, but with a higher error rate. The increase in mistakes led to costly rework, offsetting any gains in speed. Still, companies often expand surveillance in response to demands from landlords or investors who want proof that office space is being used. Surveillance also introduces new risks for workplace equity. Studies show that underrepresented groups, particularly women and minorities, are more likely to be flagged by automated monitoring systems, even when their performance matches that of their peers. This leads to higher rates of corrective actions and attrition within these groups, compounding diversity challenges. Middle managers find themselves caught between enforcing surveillance policies and supporting their teams. Many report that monitoring responsibilities take up a significant portion of their week, leaving less time for coaching or problem-solving. Bonus structures increasingly tie manager compensation to enforcement metrics, shifting focus away from leadership and toward compliance. Legal protections for employees lag behind the rapid adoption of these technologies. In most states, companies can monitor workers with little or no disclosure, and there are few restrictions on what data they can collect. High-profile cases have revealed companies tracking employee movement via Wi-Fi or other means, often without staff knowledge. The paradox is that surveillance often undercuts the very productivity it aims to boost. Employees may generate more activity logs, but the value of their work declines. High performers routinely find ways to work around monitoring systems, using personal devices or other methods to protect focus time. Meanwhile, the cost to company culture is significant. Organizations with aggressive surveillance see lower innovation scores and reduced engagement. Despite the mounting evidence that these practices do more harm than good, the adoption of surveillance continues to grow. With management and investors seeking tangible proof of office activity, companies are willing to invest in ever more sophisticated monitoring systems, even if the returns are questionable. As these pressures mount, The incentives that underpin office mandates are shifting as well. Tax financial and policy decisions. Municipal tax policies now play a decisive role in shaping where and how companies ask employees to work. Cities and states, faced with falling commercial real estate values and shrinking tax bases, have adopted new strategies to keep office buildings full. The most common approach is to tie business tax incentives and credits directly to physical office occupancy rates. This creates a financial penalty for companies that lean too heavily into remote work, regardless of what their productivity data might suggest. New York City's latest tax code links eligibility for business tax breaks to office attendance, with firms losing a significant portion of incentives if their buildings drop below set occupancy thresholds. This policy targets large employers, especially those with legacy leases and major downtown footprints. Companies like Amazon, with a sizable headquarters in Seattle, now face the prospect of losing millions in local tax benefits if they can't keep enough employees physically present. Municipalities justify these incentives as necessary to support local businesses that depend on office worker foot traffic and to stabilize city budgets reliant on commercial property taxes. Texas offers a contrasting but equally influential model. The state provides property tax discounts to companies that maintain high levels of office attendance, sometimes as much as 30% off assessed value for firms hitting weekly occupancy targets. For companies with large campuses, the potential savings are substantial, but so are the trade-offs. A business that could save thousands per employee by downsizing its real estate footprint instead finds itself weighing those savings against the risk of losing a much larger tax break. This has led some firms to reverse remote-friendly policies and require more days in the office, not because productivity demands it, but because the math of tax incentives makes it the cheaper option. The cost of unused office space adds another layer. Many companies are still locked into long-term leases signed before the pandemic, with expensive build-outs that can't be easily unwound. Paying for empty space while missing out on tax breaks quickly erodes the financial benefits of remote work. In these cases, leadership often concludes that if they're paying for the office anyway, they might as well fill it, especially when city or state policies reward them for doing so. These tax incentive traps extend beyond the US. In Europe and Asia, cities like London and Tokyo have introduced occupancy-based business rates and property tax relief, pushing companies to keep seats filled even when remote teams outperform their in-office peers. The result is a global pattern. Local governments use tax codes to nudge corporate behavior, often overriding internal data on productivity or employee preference. Hybrid work policies, particularly those requiring 3 days in the office, have become a common compromise. Gallup's research shows that hybrid workers, especially those with a midweek office schedule, report higher engagement and productivity than those who are fully remote or fully in office. This has given companies a way to justify partial office returns while still capturing some of the benefits of flexibility. Salesforce's internal data supports this, with employees favoring hybrid days in the middle of the week. For many firms, hybrid schedules align with both the requirements of tax incentive programs and the preferences of a broad swath of the workforce. Still, the financial calculus remains complex. The balancing act between tax breaks, real estate costs, and productivity gains leads some companies to optimize for incentives rather than output. Internal accounting often reveals that the savings from hitting occupancy targets precisely offset the costs of lost productivity and employee turnover. In this environment, decisions about where employees work are less about what drives performance and more about what keeps the company financially whole. These policies ripple through commercial real estate valuations and influence the strategic decisions of both tenants and landlords. As more companies run the numbers, some will choose to forego incentives and go fully remote, while others will continue to prioritize office attendance to protect their tax positions. The financial and policy environment has made the landscape far more complicated, leaving companies to make trade-offs that don't always align with what's best for their people or their bottom line. The consequences of these choices reach beyond daily routines, shaping career trajectories and advancement opportunities in ways that aren't always obvious to employees. The promotion penalty. The promotion penalty for remote workers is now one of the most persistent barriers to career growth in today's workforce. Data from the Wall Street Journal, which analyzed 2 million white-collar employees, shows remote workers are promoted 31%. less frequently than their hybrid or fully in-office peers. This gap remains even when remote employees receive equal or better performance evaluations. The underlying reason is proximity bias. Leaders and managers are more likely to notice, remember, and reward those they see in person. A KPMG survey found that 87% of CEOs admit they favor employees who show up at the office with better assignments, raises, or promotions, regardless of output. This bias isn't limited to a single industry. In technology, finance, consulting, and law, in-person presence continues to shape advancement. Remote employees often outperform in measurable ways: higher client satisfaction, more projects completed, or better error rates, yet still see fewer opportunities for raises and promotions. For example, a remote analyst at a major bank might process more transactions or close more deals than an office-based peer, but still get passed over for advancement because they're less visible to decision makers. Promotion committee notes often cite leadership presence or cultural fit, terms that usually mean being physically present. Compensation data reflects this disparity. Raises for remote workers average 2.8%, compared to 4.1% for hybrid workers with similar performance. The difference is even greater at firms with strict office cultures. This creates a cycle where high-performing remote employees switch jobs more often to reset their compensation, while in-office staff advance steadily. The promotion penalty also compounds over time, as missed opportunities lead to slower career progress and lower lifetime earnings. The diversity gains from remote hiring are also at risk. Remote roles have attracted more women and underrepresented minorities, expanding the talent pool. Yet these same employees face steeper promotion hurdles. Proximity bias undermines advancement for remote workers, so the initial diversity boost doesn't always translate into leadership representation. Some companies have tried to address this with location-blind promotion policies or remote parity initiatives, but the results are mixed. Managers still tend to give high-profile projects and stretch assignments to those they see in person, which are the very opportunities that lead to promotion. Younger employees and those early in their careers are especially vulnerable. Without regular face time, it's harder to build relationships with mentors, sponsors, or senior leaders. This lack of informal interaction can make it difficult for remote workers to stand out, even when their results are strong. Many employers now try to compensate by offering more structured career development and social opportunities during in-office days, but these efforts rarely close the gap entirely. The penalty is reinforced by the way companies measure potential. Performance reviews often reward intangibles like visibility, participation in office events, or hallway conversations. Remote employees, even those who consistently deliver, are more likely to be described as lacking presence or needing to be more involved. This subjective evaluation process means remote workers must outperform by a significant margin just to be considered on par with their office-based counterparts. The result is a steady outflow of top talent from organizations that fail to address the promotion penalty. High performers who don't see a path forward are more likely to leave, driving up turnover costs and eroding institutional knowledge. The cycle repeats as new hires face the same barriers, and companies struggle to retain the very people who drive their strongest results. These dynamics don't just affect individual careers, they shape the entire structure of the modern workforce. As companies grapple with how to reward performance fairly, the hidden costs of these biases become harder to ignore. And while some organizations acknowledge the problem, most continue to overlook a major factor that shapes employee decisions about where and how they work: the commute conundrum. The financial realities of returning to the office are often overlooked in corporate debates about productivity and culture. For employees, the costs of in-person work add up quickly and quietly. Surveys show that in-office workers spend nearly twice as much each month on work-related expenses as their remote counterparts, with transportation, meals, and pet care making up the bulk of the difference. The average in-office employee faces around $863 in extra monthly costs, compared to $423 for those working remotely. Over the course of a year, that's more than $5,000 lost to commuting, lunches, and the logistics of being away from home. Transportation is the single largest expense. Even with public transit or carpooling, daily commutes in major metro areas often mean over an hour on the road and $15 or more in out-of-pocket costs each day. For those who drive, rising gas prices and parking fees quickly eat into take-home pay. Employees who rely on downtown parking can spend thousands annually just to secure a spot near their workplace. These costs are regressive, hitting lower-paid workers much harder as a share of their salary than those in higher income brackets. Meals and incidental spending stack up as well. Office workers are far more likely to buy breakfast, lunch, and coffee near their workplace rather than prepare them at home, leading to several $1,000s in additional annual spending. Pet owners face another layer of expense, with daily pet care costs adding up quickly for those required to leave animals at home. The result is a steady drain on disposable income that doesn't appear on any corporate balance sheet, but shapes employee satisfaction and retention. Time lost to commuting is a cost that's harder to quantify, but just as significant. The average worker in a large city spends about 72 minutes each day getting to and from the office. Valued at $35 an hour, this amounts to over $8,000 a year in lost personal time that could be spent on family, rest, or side projects. The psychological toll of the daily commute is substantial, contributing to higher stress and reduced job satisfaction. Many employees cite flexibility and the elimination of commuting as their top reasons for preferring remote work. For parents and caregivers, the impact is even greater. In-office work often requires full-time childcare, which can cost thousands more each year compared to the flexible arrangements possible with remote work. These additional expenses are a key reason why many working parents, especially mothers, seek out remote or hybrid roles. The commute conundrum is not just about money and time. It's about the ability to balance work with other responsibilities and maintain a reasonable quality of life. Employers also benefit financially from remote work. Companies save on real estate, utilities, and turnover costs, with some studies estimating annual savings of over $11,000 per part-time remote employee. Yet, these savings are rarely reflected in employee compensation or offsetting benefits. Instead, the burden of office mandates falls disproportionately on workers, who are expected to absorb the extra costs and disruptions. The appeal of remote work is clear in employee surveys. More than half of professionals say they would accept a pay cut for the ability to work remotely, and a significant share would give up more than 10% of their salary for location flexibility. Millennials and Gen Z workers, in particular, prioritize remote and hybrid options, often choosing roles that offer flexibility, even if it means lower titles or slower advancement. Despite these clear financial and personal incentives, many companies continue to mandate office attendance, framing it as essential for collaboration or culture. But the data shows that for most employees, the commute is not just a minor inconvenience. It's a major factor in job satisfaction, retention, and overall well-being. This disconnect between the real costs of office work and the policies companies implement sets up a new set of challenges, especially as organizations try to balance flexibility with the perceived benefits of in-person collaboration. The hybrid illusion. Hybrid work is often presented as a practical compromise, but in practice, it rarely delivers the best of either remote or office-based models. The majority of hybrid policies require employees to spend a set number of days in the office, usually aligned with midweek peaks, which can feel more like office-first mandates than true flexibility. A 2025 survey of major employers found that 72% of so-called hybrid policies actually enforce predetermined office days, regardless of the nature of the work or employee preference. This approach can undermine the very flexibility that hybrid work is supposed to provide, leaving many employees frustrated by the lack of real choice. For many knowledge workers, the constant switching between home and office does not enhance productivity. Instead, it introduces new inefficiencies. Microsoft's internal data shows that hybrid workers spend 42% more time in meetings than fully remote employees, often due to the need to coordinate across locations and maintain visibility with both remote and in-person colleagues. The result is a workday filled with context switching, which can erode deep focus and reduce overall effectiveness. Employees often find themselves carrying laptops and unfinished tasks between environments, never fully settled in either. Managers and employees alike report that hybrid arrangements can be emotionally draining. A study by TinyPulse found that 80% of people leaders consider hybrid setups exhausting to manage. The lack of a stable routine and the pressure to be available in both settings lead to higher stress and less satisfaction. Employees are expected to adapt to shifting expectations, while managers juggle policies that rarely fit the actual workflow. This complexity can result in burnout, especially when the purpose of in-office days is unclear or driven by tradition rather than necessity. The supposed social and collaborative benefits of hybrid work often fail to materialize. While companies argue that office days foster connection and innovation, employees frequently experience the opposite. Many report feeling less connected in hybrid or in-office settings than when working fully remote, where virtual communities and structured digital communication can create a stronger sense of belonging. The FlexJobs survey found that 99% of professionals feel better working from home, at least part-time, with more than half saying full-time remote work provides the greatest well-being. Only a tiny fraction believe daily office attendance is best for their mental health. Hybrid policies can also create a sense of constant transition. Employees rarely establish a comfortable rhythm, as routines are disrupted by alternating locations and shifting expectations. The lack of consistency makes it difficult to plan focused work or personal commitments. For managers, the logistical challenge of coordinating hybrid teams means more time spent on scheduling and less on meaningful leadership. Productivity gains that were once clear in remote or hybrid models have begun to diminish, with managers in 2024 reporting a 62% productivity boost from hybrid or remote setups, down from 79% the year before. Generational differences shape the hybrid experience as well. Gallup's research distinguishes between splitters, who prefer clear boundaries between work and home, and blenders, who integrate the two. Younger employees tend to favor structured remote work, while many senior leaders still see office presence as essential for mentorship and oversight. This disconnect can make hybrid policies feel like a compromise that satisfies neither group. Despite these issues, companies continue to promote hybrid work as a solution, often to justify existing office leases or to maintain a sense of oversight. The reality is that hybrid arrangements, when implemented as rigid office-first policies, often deliver the disadvantages of both models. The distractions and costs of commuting, combined with the isolation and lack of visibility that can come from working remotely. Employees end up with less flexibility, more stress, and lower engagement. As organizations try to square the realities of hybrid work with the expectations of their workforce, another set of pressures is emerging. External forces, especially from investors and stakeholders, are beginning to influence how companies define and measure the value of office space and employee presence. Investor pressures. Investor pressures now shape many of the decisions companies make about office mandates and remote work. In recent years, major institutional shareholders like Vanguard and BlackRock have added physical capital utilization to their ESG assessment frameworks. This means companies must justify how efficiently they use their office space, not just to their own boards, but to the investment community at large. For firms that own significant real estate, empty buildings are no longer just a line item. They're a visible sign of underutilized assets, and investors are demanding explanations. This new focus on physical capital utilization creates a direct incentive for leadership to drive up office attendance, regardless of what internal productivity data might show. During quarterly earnings calls, companies now routinely address questions about office occupancy rates. For example, Salesforce has had to explain the optics and cost of half-empty towers in downtown San Francisco, even as internal reports show remote teams outperforming in key metrics. The irony is clear. The same investment firms that highlight the environmental benefits of remote work in their sustainability reports are also the ones pressuring companies to fill offices, even if it means higher emissions from commuting and building operations. These conflicting incentives are especially pronounced for companies that own their headquarters. When office buildings sit vacant, they represent both a financial and reputational risk. Investors scrutinize balance sheets for signs of wasted capital, and public companies now include physical asset utilization as a risk factor in their regulatory filings. This focus has led to stricter return-to-office policies, not because the work requires it, but because the optics of unused space can affect credit ratings, insurance costs, and stock valuations. Banks are also exposed. Wells Fargo, for instance, holds billions in commercial office loans, and any drop in office valuations forces them to increase reserves against potential losses. As defaults rise and occupancy rates stagnate, Banks have a vested interest in supporting policies that keep offices full. The financial sector, in turn, lobbies for office mandates, knowing that widespread remote work could trigger significant write-downs across their loan portfolios. This interconnectedness means that a company's decision to allow remote work is rarely just about employee preferences or productivity. It's about maintaining the value of assets that underpin the broader financial system. Municipal governments add another layer of complexity. Many cities tie business tax incentives and property tax breaks to minimum office occupancy rates. While the specifics vary, the result is the same. Companies that reduce their office footprint risk losing out on millions in local tax credits. Boston, for example, estimates that underutilized office space could cost the city over $80 million in lost revenue, prompting local policymakers to pressure employers to maintain downtown presence. These municipal incentives often outweigh the internal savings companies see from remote work. The insurance industry compounds these pressures. Property insurers have started charging higher premiums for buildings with low occupancy, citing increased risk profiles. This further incentivizes companies to keep desks filled, regardless of operational need. At the same time, real estate investment trusts, REITs, and pension funds with large commercial portfolios push for higher utilization rates to stabilize returns. These groups sometimes negotiate lease amendments with tenant companies, offering rent reductions in exchange for documented increases in office attendance. Amid all this, a generational divide is emerging in investment strategies. While traditional institutional investors focus on physical asset utilization, some newer funds and younger investors prioritize flexibility and remote-native business models. This split is starting to influence how companies weigh the costs and benefits of their real estate decisions. But for now, the dominant pressure still comes from those with the most capital at stake in physical infrastructure. The result is a set of contradictions that show up in corporate communications and annual reports. Firms tout the sustainability benefits of remote work to one audience, while assuring investors and lenders that their properties are being used to full capacity. This double messaging reflects the unresolved tension between environmental goals and asset utilization metrics. These investor-driven pressures have a profound impact on how organizations structure their work environments. But while companies focus on occupancy rates and asset utilization, another problem often goes unaddressed: the way they actually measure employee productivity. The productivity measurement problem. Across industries, the way companies track productivity has not kept pace with the realities of modern work. Many organizations continue to rely on traditional metrics like attendance, desk time, and visible activity, because these are easy to observe and quantify. Yet, these measures often have little to do with actual output or the value employees deliver, especially in remote and hybrid environments. The result is a persistent mismatch between what gets measured and what really matters. In creative and technical fields, this gap is especially clear. Remote teams frequently report higher levels of innovation and deeper focus, but these gains rarely make it into formal evaluations. For example, research from Stanford shows remote knowledge workers spend more time on deep work, leading to measurable improvements in both quality and creativity. Despite this, performance reviews still tend to reward office presence or participation in scheduled meetings, rather than the tangible results of a project or campaign. The emphasis remains on what's visible to supervisors, not on the outcomes that drive business success. The consequences of this measurement problem are far-reaching. Employees quickly learn that being seen is often more important than what they accomplish. This leads to what some call productivity theater, workers putting energy into appearing busy or present, rather than focusing on meaningful tasks. In companies where badge swipes or logged hours are tracked more closely than project milestones, staff may prioritize visibility over results. The disconnect between management perceptions and employee contributions grows, especially when remote workers outperform, but remain less visible to decision-makers. This focus on easily measurable metrics can distort performance evaluations in every sector. In banking, for instance, remote loan processors may handle more applications with fewer errors, but their reviews still prioritize office attendance and cultural contributions. In consulting, hybrid workers might log more client-facing hours, yet deliver fewer actionable recommendations than their fully remote peers. These patterns repeat in law, healthcare, and engineering, where output and innovation are often overshadowed by subjective measures tied to physical presence or participation in office rituals. The reliance on outdated evaluation methods also undermines trust. Executives sometimes respond to the uncertainty of remote work by increasing surveillance and monitoring, hoping to ensure accountability. However, research shows that ramping up monitoring actually correlates with lower engagement and reduced motivation. When employees feel watched rather than trusted, their focus shifts from delivering results to managing perceptions. This cycle does little to improve true productivity and can erode morale over time. Generational differences further complicate the issue. Younger employees, who tend to thrive in remote settings and show higher productivity in structured, results-based environments, often face evaluation systems built for a different era. Performance reviews may still reward office behaviors that matter less in a digital-first world. As a result, high-performing remote workers are frequently overlooked for promotions or raises, even when their contributions are clear in the data. This perpetuates a system where advancement is tied to visibility, not value. Attempts to modernize performance management often fall short. Some companies introduce new output-based metrics, but these are frequently layered on top of old systems rather than replacing them. The result is a confusing mix of criteria that leaves both employees and managers dissatisfied. Without a fundamental shift toward measuring what truly drives business outcomes, organizations risk losing top talent and stifling innovation. The challenge is not just technical, it's cultural. Moving away from legacy metrics requires rethinking how work is defined, tracked, and rewarded. Companies that make this transition can better recognize and motivate their best performers, regardless of where or how they work. Those that cling to outdated measures, however, may find themselves missing out on the real benefits of flexible work models. While much attention is paid to the visible costs of office mandates, the hidden impact of flawed measurement systems is just as significant. Companies may overlook the real savings and performance gains that come from modernizing how they evaluate productivity, costs and benefits that rarely appear in official reports, but matter despite the attention paid to office utilization metrics and visible activity. The actual financial benefits of remote work are substantial and well documented. Companies like Dell have realized savings of around $11,000 per employee each year by reducing office space, utilities, and other overhead costs. These savings, confirmed by Harvard and Stanford research, are not unique to one company or industry. In fact, more than 80% of large firms have downsized their office footprints since 2020, but the details of these cost reductions rarely appear in shareholder communications or public filings. Instead, leadership often continues to highlight office attendance and physical presence, even as the balance sheets quietly reflect the benefits of a smaller real estate footprint. Turnover costs represent another area where remote work delivers clear financial gains. Buffer's data shows that remote workers are 41% less likely to resign than their in-office peers. This reduction in attrition translates to significant savings in recruitment, onboarding, and training, expenses that can add up quickly, especially in industries with specialized roles. Yet, these benefits are often buried within general HR budgets, with little direct attribution to remote work policies. The focus remains on what can be easily measured, such as badge swipes or occupancy rates, rather than the underlying improvements in retention and workforce stability. Productivity gains from remote and flexible work arrangements also go largely unreported in official financial statements. Studies from Stanford and other research groups consistently show that remote teams deliver more focused hours of deep work, leading to higher output and fewer mistakes. These improvements can equal thousands of dollars in additional value per employee each year, but they are rarely broken out in earnings presentations or investor calls. Instead, companies prioritize metrics that align with traditional office models, even when the data suggests that remote work is driving better results. Tax incentives and real estate obligations further complicate the picture. Many companies maintain office mandates, not because they drive productivity, but because municipal tax breaks and long-term lease agreements make it financially convenient to keep seats filled. The immediate benefit of a tax credit or the avoidance of lease penalties often outweighs the less visible, but more substantial long-term savings that come from a remote or hybrid workforce. This dynamic leads to a situation where the true cost advantages of remote work are sidelined in favor of short-term financial incentives and legacy commitments. The lack of transparency around remote work savings is not always intentional. In some cases, companies may not fully understand the scope of the financial benefits, especially when savings are spread across multiple departments and line items. Overhead reductions, lower turnover, and improved productivity can be difficult to quantify in a system built around physical presence and office utilization. As a result, the real value of remote work remains hidden, both from shareholders and from employees who might otherwise advocate for more flexible policies. Investor priorities also influence what gets reported. With ESG frameworks now including physical capital utilization, companies feel pressure to show that their office space is being used efficiently. This can lead to selective reporting, where the narrative focuses on occupancy rates and office culture, while the financial upside of remote work is left out of the conversation. The result is a disconnect between what is actually happening on the ground and what is presented to the investment community. These patterns have real consequences for how companies compete for talent and structure their operations. As more organizations quietly benefit from remote work savings without publicizing them, the firms that embrace transparency and flexibility gain a competitive edge. The landscape is shifting, and the companies that recognize and act on the true financial advantages of remote work will be better positioned in the years ahead. This growing divide is beginning to reshape the dynamics of hiring and retention across industries. The coming talent war. The next front in corporate competition isn't just about products or profits. It's about who can attract and keep the best people. As the labor market tightens and skilled workers become more selective, the willingness to offer remote and hybrid roles has become a decisive advantage. Research shows that while remote and hybrid positions make up less than 15% of all job listings, they draw over half of all applications. The message from job seekers is clear. Flexibility is no longer a perk, but a baseline expectation. Companies that lean into remote work fill critical roles faster and with stronger candidates. Remote job postings attract nearly all of the application volume, while office-bound roles languish, often requiring longer searches and higher compensation just to compete. This shift is driven by more than just convenience. The vast majority of employees, 91%, say they would prefer to work fully or mostly remotely, and 83% find a hybrid schedule ideal. Flexibility around location is now one of the most important factors influencing where people choose to work, outpacing salary and title for many. The benefits go beyond hiring speed. Firms that embrace remote or hybrid models see higher satisfaction and retention. Employees value autonomy and work-life balance, and they're willing to trade off pay for it. More than half of professionals would accept a pay cut of 5% or more for location flexibility, with nearly a quarter willing to take a reduction of over 10%. For employers, this means access to a broader, more motivated talent pool without the need to outbid competitors on salary alone. Remote work also expands the reach of recruitment. Companies are no longer limited to candidates within commuting distance of their headquarters. Open roles draw applicants from across regions, time zones, and backgrounds, speeding up hiring and reducing the risk of skill shortages in specialized fields. This geographic flexibility is especially valuable in technical and creative sectors, where the best candidates may be scattered far from traditional industry hubs. Diversity and inclusion efforts benefit as well. When companies list roles as remote, applications from women increase by 15% and from underrepresented minorities by 33%. The option to work from anywhere opens doors for people with disabilities, caregivers, and those in rural or underserved areas, groups often excluded by rigid office requirements. Since the rise of remote work, labor force participation among people with disabilities has grown by 2 million in the U.S. alone, a shift that would have been nearly impossible under old attendance models. Retention data reinforces the advantage. Companies with flexible work policies report lower turnover and higher employee loyalty. Workers who have the option to work remotely are more likely to stay, reducing the steep costs of recruiting, onboarding, and training new staff. In contrast, firms that maintain strict office mandates face higher attrition, slower hiring, and greater difficulty attracting specialized talent. This is especially pronounced in sectors like finance, healthcare, and engineering, where remote-friendly organizations now outpace their competitors in both hiring velocity and workforce stability. Generational preferences add another layer. Younger workers, especially Gen Z, overwhelmingly favor remote or mostly remote roles. Companies that fail to adapt see higher turnover among early career staff, while those that offer flexibility build a pipeline of future leaders. The competition for talent is no longer just about immediate needs, but about shaping the workforce for years to come. The implications are clear. Remote and hybrid work are now central to talent strategy. Companies that resist this shift will find themselves left with a shrinking share of the available workforce, forced to pay more for less satisfied employees. Those that recognize the new reality can hire better people, faster, and at lower cost, gaining a structural edge that office-bound rivals struggle to match. But while the workforce moves toward flexibility and autonomy, decisions about office mandates are still shaped by a very different set of priorities at the top. The gap between what employees want and what executives enforce is not just a matter of policy, but of power, and it's here that the next chapter of the workplace story unfolds. The power dynamics. Inside most companies, decisions about where and how people work are shaped by a small group at the top. These leaders, often insulated by private offices and short commutes, set policies that affect thousands of employees who face long journeys, crowded workspaces, and little control over their environment. The result is a clear power imbalance. Those who benefit most from office perks are the ones most likely to enforce return-to-office mandates, while the majority of employees carry the daily costs. Surveys reveal a stark divide in preferences. Executives are twice as likely as employees to believe in the value of in-person work, and their negative perceptions of remote work drive much of the policy. For many leaders, the office represents more than just a place to work. It's a symbol of status and control. Private offices, reserved parking, and access to exclusive amenities reinforce a hierarchy that is rarely questioned at the top, but felt acutely by those lower down. When policies are crafted, these privileges remain protected, while the broader workforce faces stricter rules and less flexibility. Double standards are common. At some global banks, executives retain the option to work remotely or set their own schedules, while junior staff must badge in daily and share open-plan desks. In the tech sector, senior leaders often maintain access to private spaces and flexible arrangements, even as the majority of employees are required to follow rigid schedules and hot desking policies. These patterns persist despite clear evidence that senior leaders spend most of their time in virtual meetings, regardless of location. The generational divide deepens these dynamics. Senior managers, especially those who built their careers in traditional office environments, tend to value face-to-face interaction and physical presence more than younger employees. This preference shapes policy, with older executives more likely to mandate in-person attendance, even as their own roles require less time in the office. For many, the office is not just a practical space, but a stage for rituals and routines that have defined their professional lives. The skills that help them advance, like reading a room or making connections in hallways, are less relevant in remote settings, leading to resistance against change. Financial pressures play a role as well. After stock price declines, many companies tighten office policies, hoping that increased visibility and collaboration will boost productivity and improve the bottom line. Yet, these decisions are often made by leaders who are least affected by the inconvenience of commuting or the realities of open-plan layouts. The push to fill office space can also serve as a quiet strategy for reducing headcount. By making in-person attendance mandatory, companies know that some employees will choose to leave rather than comply, achieving cost cuts without the negative headlines of layoffs. The structure of these decisions remains top-down. Most return-to-office policies are set by executives and enforced by middle managers, whose own advancement often depends on visible compliance rather than team performance. Managers may schedule unnecessary meetings or emphasize attendance to signal alignment with leadership, even when it adds little value to the work itself. This focus on presence over output keeps traditional hierarchies intact and discourages innovation from below. The physical workspace itself becomes a marker of power. Private offices, executive floors, and exclusive amenities are maintained, while most employees adapt to shared desks and crowded environments. The justification is often framed in terms of collaboration or culture, but the real effect is to reinforce existing status differences. Even wellness and flexibility benefits follow these lines, with top leaders retaining access to resources unavailable to most staff. As the balance of power tips further toward employers in a cooling job market, companies have less reason to offer flexibility. The result is a widening gap between leadership priorities and employee needs. Policies that favor executive comfort and control may deliver short-term stability, but they risk alienating the very people whose ideas and energy drive the business forward. Under these conditions, the long-term consequences become harder to ignore. When decision-making is concentrated at the top and rooted in preserving traditional structures, the space for new ideas and genuine innovation shrinks. This shift in power dynamics doesn't just affect morale, it shapes the future of what companies can achieve. The innovation drain. Innovation inside organizations depends on more than just talent or resources. It relies on the conditions that allow novel ideas to surface and grow. The shift toward remote work has quietly changed those conditions, and the results are showing up in how companies generate new products, services, and intellectual property. While the debate about office mandates continues, data from across industries points to a clear pattern. When employees have more autonomy and fewer interruptions, they consistently produce more innovative work. Studies find that remote software teams file 13% more patents than those working in traditional office environments. This isn't an isolated trend. Across engineering, design, and technical fields, remote workers report 27% higher innovation levels, according to Stanford and Owl Labs research. The explanation is straightforward. Deep focus, periods of uninterrupted concentration, are much easier to achieve outside the distractions of a physical office. In contrast, mandatory in-person collaboration often leads to groupthink, where consensus overrides original thinking and the pressure to conform stifles creative risk-taking. Hybrid and office-first mandates tend to reduce innovation outputs by up to 20%, a figure supported by multiple studies spanning sectors from technology to healthcare. When companies require regular office attendance, employees spend more time commuting, preparing for meetings, and navigating office politics. The time and energy lost to these routines directly subtract from the hours available for deep, creative work. As a result, fewer patentable ideas are generated, and the quality of those ideas can decline. Diversity plays a crucial role in innovation, and remote work expands access to a wider range of perspectives. A Wharton study found that remote job postings draw 15% more applications from women and 33% more from underrepresented minorities. This broader talent pool feeds into more original solutions and breakthrough ideas, which are less likely to emerge in homogeneous, office-bound teams. Companies that maintain flexible work policies are better positioned to tap into these diverse viewpoints, which is increasingly important in a global business landscape. The technological shift is also shaping innovation. Generative AI, virtual reality, and advanced collaboration tools are enabling distributed teams to work together on complex projects in ways that were previously impossible. McKinsey reports that generative AI can automate up to 70% of routine tasks, freeing up employees to focus on higher-level problem-solving and creative work. Virtual workspaces and asynchronous communication allow teams to contribute across time zones, further increasing the volume and quality of new ideas. However, these benefits are not automatic. Organizations that simply offer flexibility without investing in the right training or technology often see the opposite effect: communication breakdowns, disengagement, and missed opportunities. Gallup research shows that only 28% of managers have received formal training in leading hybrid or remote teams. Without this support, even the most talented employees can struggle to collaborate effectively or turn new ideas into real products. The long-term risk for companies that prioritize office mandates over innovation is difficult to overstate. Patent portfolios, new product pipelines, and breakthrough solutions are built over years. When innovation slows, the effects may not be visible in quarterly reports, but the competitive disadvantage compounds over time. Firms that fail to adapt may find themselves outpaced by more flexible competitors who are better able to attract and retain creative talent. This innovation drain creates hidden costs that don't show up in standard financial statements. While companies focus on filling office space and maintaining traditional routines, they may be overlooking the true drivers of future growth. The consequences are not limited to missed business opportunities. They also show up in the day-to-day experiences of employees, as pressures mount and the workplace becomes less conducive to meaningful work. The wellness trade-off. The wellness trade-off is becoming impossible for companies to ignore. Office workers consistently report higher stress levels and take more sick days than their remote counterparts. A 2025 study found a 23% gap in stress and a 15% increase in absenteeism among those required to commute. The traditional office environment, shaped by long commutes, rigid schedules, and constant social pressures, feeds into burnout and chronic health issues. The result is not only higher healthcare costs for employers, but also a workforce that is less resilient and more prone to disengagement. Commuting remains a major driver of stress. Office workers spend close to 8 hours each week just traveling to and from their jobs. This lost time, combined with the unpredictability of traffic, public transit delays, and the need to arrange childcare or pet care, adds another layer of anxiety. The impact isn't just psychological. Studies show that those who commute daily report higher blood pressure and more frequent doctor visits for stress-related conditions. Yet, instead of addressing the root causes, many companies focus on surface-level perks, meditation rooms, nap pods, and free snacks that do little to counteract the daily grind. Financial strain compounds the problem. For many employees, the extra costs of office work, transportation, meals, and business attire amount to a significant pay cut. Research highlights that these expenses can total several $1,000s per year, hitting lower and mid-level employees the hardest. Despite this, the most common corporate response is to offer small perks or financial literacy workshops, rather than address compensation or provide real flexibility. The physical office itself rarely helps. Open-plan layouts, designed to foster collaboration, often lead to more interruptions and higher stress. Employees in these environments report more distractions, increased noise, and elevated cortisol levels. The most requested office amenities are not game rooms or gyms, but quiet spaces and privacy, features that less than half of employees say their offices provide. While some companies are investing in redesigns, most workplaces still fall short of supporting true well-being. Presenteeism, the pressure to show up even when unwell, remains a persistent issue. Office workers are more likely to attend work while sick, increasing the risk of spreading illness and driving up indirect costs for employers. Remote workers, by contrast, take fewer sick days and are more likely to seek preventative care, leading to better health outcomes overall. Mental health is another area where remote work has clear advantages, but also some trade-offs. Fully remote workers are the most engaged at work, according to Gallup, but they are less likely to say they are thriving in their lives overall compared to hybrid or on-site peers. The lack of in-person interaction can contribute to feelings of isolation and loneliness, especially when companies do not invest in intentional connection or support structures. Still, office workers report higher rates of anxiety and depression, with many unable to access mental health resources during the workday. Utilization rates for employee assistance programs remain low, especially when services are only available on-site or during limited hours. Generational differences shape wellness needs as well. Younger employees are more likely to prioritize mental health days and flexible schedules, while traditional wellness offerings, like on-site gyms, see little use among these groups. Companies that adapt to these preferences by offering mental health resources, flexible time off, and digital wellness platforms see higher engagement and lower turnover among early career staff. Financial wellness is closely tied to overall well-being. A majority of office workers report daily worries about money, far more than their remote peers. While financial wellness programs can help, they are most effective when paired with policies that address the underlying costs and pressures of in-person work. Transparent communication, fair wages, and reasonable hours do more to support employee health than any single program or perk. The pattern is clear. Organizations that prioritize people-centered policies, fair pay, flexible work, and support for physical, mental, and financial health build more resilient and productive teams. Those that focus on visible but superficial wellness initiatives miss the real drivers of employee well-being. As companies weigh the costs and benefits of their workplace strategies, the trade-offs around wellness will only become more pronounced. The coming months will force difficult decisions about which priorities truly matter and which approaches are sustainable. A major shift is underway in how companies approach their office footprints. After years of uncertainty, the commercial real estate market is reaching a decisive moment. Lease expirations between 2026 and 2027 will require companies to make decisions on hundreds of billions of dollars in office space. Many organizations have already responded to changing work patterns. About 80% have downsized their office space since the pandemic began, and 75% plan further reductions. This is not a temporary adjustment, but a structural change in how businesses evaluate real estate. Companies that once saw large headquarters as a mark of prestige now focus on maximizing the value of smaller, more flexible spaces. Vacancy rates reflect the scale of this transformation. Nationally, office vacancies hover around 20%, with wide variations across major cities. New York's rate is 13.3%, while San Francisco's sits at 22.1%. These numbers reveal a market in flux, with no single approach dominating. Some firms have moved quickly to adapt. Companies like Dropbox and Atlassian have shifted to remote-first models, treating offices as optional collaboration hubs. For them, the benefits are clear: lower costs, improved productivity, and the freedom to hire from a wider talent pool. By locking in flexible work policies early, they avoid the financial strain of underused real estate. Other sectors face more complicated choices. Law firms and financial institutions have long relied on prestigious addresses to signal stability and trust. For these organizations, downsizing offices means rethinking not just their physical space, but their entire brand identity. Many are caught in the middle, mandating office returns for some staff, while quietly making exceptions for top performers. These mixed policies delay hard decisions, but as lease renewals approach, the underlying economics become harder to ignore. Landlords and municipal governments add further complexity. Many property owners offer rent reductions or incentives for maintaining high occupancy rates, while cities tie business tax breaks to office utilization. Boston, for example, estimates that underutilized office space could cost the city more than $80 million in lost revenue, putting pressure on companies to keep employees coming in. These arrangements encourage firms to keep offices fuller than necessary, even when productivity data suggests otherwise. The result is a patchwork of short-term fixes that cannot hold as the financial realities become more pressing. The next phase will separate companies that act decisively from those that delay. Firms willing to align their real estate strategies with actual work patterns will see lasting benefits in cost, talent, and operational flexibility. Early adopters are already attracting better candidates at lower costs, while those clinging to office-centric models pay more for less satisfied employees. The contrast is especially clear in sectors like finance and technology. Banks that enforce strict office mandates risk losing top analysts to competitors offering flexibility. In tech, companies built around distributed teams avoid the overhead of expensive campuses and redirect resources to growth and innovation. Workforce dynamics are accelerating these trends. Younger employees, especially Gen Z, increasingly reject traditional office requirements. Companies that insist on daily attendance face shrinking talent pools and higher attrition, while those that embrace remote work report lower turnover and more diverse hiring pipelines. The evidence from firms like Airbnb, which saw a significant drop in attrition after adopting permanent remote policies, highlights the compounding advantages of flexibility. At the same time, the options for companies are narrowing. Converting office buildings to other uses, such as residential space, remains costly and impractical in most cases. With long-term leases expiring and fewer financial incentives to maintain large footprints, the pressure to downsize will only intensify. The structural challenges in commercial real estate, high vacancy rates, slow-moving lease cycles, and limited conversion opportunities, mean that this reckoning cannot be postponed indefinitely. Some industries will face especially tough adjustments. Healthcare systems, retail banks, and organizations with extensive administrative offices must balance long-standing real estate commitments against changing workforce needs and digital transformation. The decisions made in the coming months will have lasting implications for cost structure, talent strategy, and business resilience. As companies navigate these choices, the data consistently favors flexibility. Remote and hybrid work models deliver measurable gains in productivity, cost savings, and employee satisfaction. Yet, with billions in lease decisions approaching, many organizations remain caught between old assumptions and new realities. The firms that adapt their property strategies to match the way their teams actually work will be positioned to succeed, while those that hesitate risk falling behind. This moment of reckoning will not just reshape office skylines. It will define which organizations are prepared for the future of work. As companies weigh their next moves, the reality is clear. Despite well-documented savings from remote work, real estate debt, and entrenched management practices continue to shape office policies. Skilled professionals overwhelmingly prioritize flexible roles. 62% now seek remote options, leaving firms with strict office mandates at a disadvantage in today's job market. Companies like GitLab, which adopted remote first early on, have seen stronger retention and broader access to talent, while others struggle to keep pace. The choice ahead is not just about cost or tradition, but about aligning workplace strategy with proven outcomes and employee needs. If your organization is navigating these changes, or if you've experienced the impact firsthand, share your thoughts or solutions in the comments below. What policies do you think actually work?